All right, let's jump into our financial 15. So I'm just going to get myself together here. So if you're just joining us on YouTube or while on YouTube, hit the subscribe, like, and notification button so that you're sure never to miss one of our videos that come out. And we do these very frequently, if not every week. And we break it down. We first have a weekly webinar. We're for about a half an hour. I talk about some IRA distribution rules and updates, and we talk about the markets. And then every week we have a financial planning topic. And today's financial planning topic is, you're 55 years old. What should you do now? And in fact, the title is 55 years old. Do this now. This is not an exhaustive list. There are other things that you probably should be doing as well, but I want to give you some basics because 55 is that time for many people when they say, okay, I'm about 10 years from retirement. If truly I'm going to retire at 65, I'm about 10 years from retirement. Bam, that goes quickly. Think about the last 10 years. I want you to think for a second about what you were doing 10 years ago, and it feels like yesterday. So suddenly you're going to be at 65. And we see these suddenly 65 people all the time. That sounds like a good book title, right? Suddenly 65. But we see these suddenly 65 people all the time saying, oh, I'm going to retire. I'm going to retire in 6 months or next year. What should I be doing now? And everybody, I don't think I've had anyone who has said to me, I'm glad I waited until now. Most people say, I wish I would have heard this, or I wish I would have started this, or I wish I would have learned this 10 years ago. Can you start telling my kids and my younger friends about this? So now here you are. I'm talking to you 55-year-olds. So you folks who are older than 55, think about people close to you. But here we are. You're 55 years old. There are things that you should be doing. So now you have this realization. If you have a family to take care of, if you have a family plan for, if you're single and you're just worrying about yourself, geez, that can be sometimes more challenging. But what most people realize at age 55 and most people we see is, okay, now most of my debt is gone, or I've got a good track for that, or it's not as impactful or as meaningful as it was before. Look at that. I've got some significant savings and investments. I got these different retirement plans in different places. What do I do with those? How do I really start getting my arms around this? So let's talk about the first thing. Pay attention. Pay attention to details. Now, some of you keep very tight budgets, cash flows, whatever you want to call it. We refer to them as expenses. Cash flow reports. Budgeting has a negative connotation and just really freezes people up. So we stay away from that word. But so we have people who come to us and say, Mark, I've been tracking my expenses for the last 35 years. I have it all in a spreadsheet here that you can review it. And that's great because those folks, I'm going to tell you, are usually way ahead of the game, at least from a savings point of view. So start paying attention to details, those expenses. You can get granular if you want, but at least have an idea of what you're spending every month. And when you start paying attention to what you're spending every month, whether it's on the grand scale or granular, as I said, then you're going to start seeing opportunities, and you're going to start seeing times, when there's less of an opportunity because of things you've done. So pay attention to those expenses. Pay attention to those investments. I had a fellow who was in his mid-60s who came to us in a class, and he said afterwards, I never heard the word Roth before. I never heard the word RMD before. That's really, really unusual. But the thing is, you have other things going on. You're coaching, you're establishing yourself in your career. If you have a family, you're taking care of your kids. You're trying to stay active. You're trying to stay healthy. All these things, and you just amass these things. Most people come to us and they say, I've got my money in an age-based portfolio. Easy thing to go to. Or I have it sitting on a CD because, or the fixed account because I don't understand the markets, therefore I'm afraid of it. And some people say, I just put it in the most aggressive, or throw a dart at it but most don't pay attention to them. So start paying attention to your investments, and you might have things all over the place. You might have a 401k over here. You might have an IRA over here. You might have something called a 403b over here. You might have a TD Ameritrade account. Well, that doesn't exist anymore, so it's Schwab now. You might have a Schwab account. You might have a Robinhood account. You might have this account, this account, this account. And how are you managing that? So start getting your arms around it. There is a lot of you can potentially work with someone like us who can help you with that. We're going to talk about finding that, putting that team together. But there are platforms you can use as well if you're not ready for that step yet. If you're not ready for that step to work with a good financial planner, maybe you don't have the resources to work with a good financial planner at this point. I don't know. But there are, listen, it's 2024. So sitting here July 3rd, 2024, there are a lot of good resources out there to help you aggregate portfolios. I talked about one of them. It's called Seeking Alpha. So that's not a recommendation. I have nothing to do with Seeking Alpha, but it's a tool that I use where I list my portfolios. Now I have many of those. I of course have my own financial plan. I use, a watch list on our custodian platform. But if you're just starting this and you're just starting to pay attention, you can find a free service where you can start listing your investments and getting a handle on it. So start paying attention to the details. Contributions to your retirement plans, contributions to your taxable accounts. You want them to be automated. So, of course, your retirement plan contributions are automated. You've got payroll deductions that get sent right to your retirement plans. But you want them, even your taxable accounts should be automated. I'm just going to use me as an example. I have a certain amount that comes out of my checking account every month that goes directly into my investment account. Same for my HSA, same for my just taxable investment account. Because I don't want to miss it. I know if it's not automated, it'll be a month or two and I'll say, oh, darn it, I've got that money there that I have to move over. Well, this way it hits my investment account. And I immediately invest it myself, but you could set it up where it's automatically invested in whatever your allocation should be. So pay attention to those details. Pay attention to the tax category. Pay attention to your money that's in your taxable account, your IRA, your Roth IRA, or your traditional 401k, your traditional 403b, your Roth retirement plans. Pay attention to those tax categories because they are going to be vitally important in the future, and it may make sense for you to shift your contributions from traditional IRAs, traditional 401ks to Roth. There's a lot of things, but one of the top things that I've heard people say when they look back, they're sitting at my table at 60, 65 years old, and they say, geez, if I could have done that 10 years ago, it would have made all the difference in the world because now I have all this money in a traditional IRA. And now by that, I'm saying changing those contributions to Roth IRAs, Roth 401ks. I talked during our weekly webinar segment about how Roth 401ks are so prevalent today. It used to be that few companies had Roth 401k options, and that's changed now. Most companies have a Roth 401k options. More and more companies allowing you to convert within that Roth 401k. So that's all good news. So take advantage of it. It may make sense for you to redirect your savings. Now you're over 50. This year you can put $30,500 of your money into your 401k. It may make sense for you to put it in Roth instead of a traditional IRA. So you build that up over the next 10 years into the Roth IRA. It could be the next 20 years. You don't have to take money under current tax code out of those accounts until you're 75. If you're 55 years old, it's going to be 75 for you. Those of you who are close to RMD age, it's 73. So don't confuse that. But that age increases to 75. So pay attention to that tax category. Now, put together your team. If you're able to, it's time to start considering putting together your team. So I'm going to go through these, but you often see me use this example here. I want you to think about it this way. First of all, you want a good CFP, certified financial planner. If you're going to have a financial advisor, I think that person should be a certified financial planner. Why do I think that person should be a certified financial planner? Because that is the most difficult designation to achieve in the financial planning industry. Only about 50 to 60% of the people who take the CFP exam pass it because it is challenging. It takes sometimes years just to pass, get the education, and you got to sit for 5 or 6 exams before you can sit for the comprehensive exam. And the comprehensive exam is a bear. And when I took it, it was a 2-day, 11-hour test, and you had to be proficient in every category. So it proves proficiency. There's an ethics requirement. This is a starting place. You at least want your financial advisor to be a certified financial planner. Why not? Why not have your person be someone who's striving to be at the top of their game, be the very best out there? If you're focused on retirement planning, this person should also have a specialty in retirement planning. They should be educated, qualified, and specialized in tax planning, distributions from IRAs. I'm going to tell you a secret, folks. Most financial advisors, most stockbrokers, most financial planners are really, really good at the investment side. It's pretty easy to find somebody who can help you manage your investments in a good way. It's really hard to find someone who can help you come down that distribution mountain, who understands the nuances and the potential pitfalls. If you just joined us for this section, go back to the full webinar, and I want you to hear some of the questions from the Slott mailbag and the discussion about premature distributions from a Roth 401k. These are things that can trip somebody up. And it's not just if you're prior to 59 and a half, but there's plenty of landmines after 59 and a half. So you want somebody who can address those issues and be ahead of it. So educated, qualified, and specialized. You, of course, want that financial advisor to be a fiduciary. So if one of my designations you see after my name here at the bottom of the screen, wherever that is, right here, right, I don't know where the heck I am, right over. Okay, it's at the bottom of my screen, is AIF, Accredited Investment Fiduciary. When I first earned this designation back in 2010, I think it was, 2011, hardly, and I said the word fiduciary to you, hardly anybody would know what that means. Today, almost everybody does. So that means somebody who is only acting in your best interest, does what's in your best interest first, foremost, all the time. Shouldn't that be just the standard and how it is? We're getting there, but I got to tell you, the large firms and the industry is fighting it tooth and nail. There's a new regulation that comes out in September that gets us closer to that, and you should just hear all the people who are upset about this. So make sure your financial advisor, your financial planner is truly a fiduciary. And if you ask them if it's a fiduciary and they say it depends, well, then they're not truly a fiduciary. You want your financial planner to be a tax planner. So if you see these large firms, they have right at the bottom of their statements, we do not offer tax advice. Well, folks, that's one of the largest expenses you're going to have in your lifetime. You want somebody who understands and can help you plan around your taxes. And again, you want that person to be educated, qualified, and specialized. You want a good tax preparer. And in my opinion, you want that tax preparer to be a CPA. For all the reasons I talked about, you want your financial advisor to be a CFP. You want your tax preparer, in my opinion, to be a CPA. Qualified, educated, has shown proficiency by passing those CPA exams. They're tough too. And so you want that person to be a CPA, and you want that CPA to have a planning mindset. Most CPAs drive in the rearview mirror, and it's really, really hard to find good CPAs that are also have a planning mindset. We often work with CPAs, and we bring them along and we teach them, about that, and really do the planning alongside of them. So it's not impossible to coach up a good CPA, but they're hard to find. The next is an attorney. So when you're 55, unless you have a business and real estate, things like that, you want to have your attorney on your team, and that's for anybody. But you want a good estate attorney. You want, in my opinion, you want that estate attorney to also specialize in elder law. So at 55, your parents may still be with us, and they might have specific needs around their health and things that are going to be triggered where you could use a good elder law attorney. A good elder law attorney can be invaluable to this team. And at some point, folks, you yourself, hopefully you're going to be elderly. So you want that person to understand who you are and what your needs are. So you want that good attorney. And you want all these folks communicating together and working for you. This is an ongoing thing. Your financial planner, you're developing your financial plan, having conversations with your attorney, your CPA. All these things should be an ongoing rotation. It all should be focused on you and meeting your goals, objectives, and finding the best way to do that. Simple. It's hard to put together that team, but being at age 55 is a really good place to start. Many people come to us and say, will you help me put together that team? Of course we do. But, and whether you're 55, 65, 70, you should have that team in place. But imagine if you're 70 and you're listening to this, imagine what it would have been like to have that team working for you 15 years ago. So put your team together. Develop a financial plan. Develop a financial plan. So many people come to us and say, I've been saving and investing all these years. We've had a lot of good growth. I just don't have a plan. And even if they've been handed a plan, I met with a person yesterday and they had a 100 and some page document they shared with me that is a quote unquote financial plan. And it said nothing. It said a lot, but it really didn't tell them anything. Does that make sense? It didn't allow for, it probably allowed for the scenarios of increased taxes and increased costs of medical in your retirement and taxation of Social Security and increased income-related monthly adjustment amounts and sudden death of one of the parties. But this was not, and not just sudden death as far as cash flow, but sudden death as far as taxation and distribution of assets and the overall effect of that. So it didn't speak to that at all. All it told them was, hey, jolly good time. You're going to be fine when you retire. But the truth is, if there's a negative market when they retire and significantly increased taxes, they're likely to be in not such a great shape when they retire. So wouldn't you like to know these things ahead of time? These are those critical items that you hopefully will know ahead of time instead of having to react to. And as these critical items build up, if you're not ahead of it, it could greatly affect your ability to retire in 10 years if you're 55 years old at 65, or maybe it's 70, or maybe it's never if you're not ahead of these things. So you need a truly comprehensive, we're going to just make it so you can see that, a truly comprehensive financial plan. You need to review this annually. You've all heard me say this over and over again, but you need to have a truly comprehensive financial plan. We have an 8-week process where we go through and we shake all the trees. I've never heard a person sitting across from the camera or sitting across from the conference room when I've said to them, I think we do a really good job of identifying your future expenses, your immediate expenses, your future expenses, and really getting a handle of what your needs are going to be and not leaving any stone unturned. Everybody agrees with that. Because if you don't have that foundation of information, correct information, you can't identify unknown potential issues. You can't really develop a true financial plan. And unfortunately, what most financial planners do, where I coach other financial planners, financial advisors around the country, but what most others do is they say, Walter, you say you need to spend $10,000 a month. Boom, boom, boom. They plug that into their plan. And that's what they work off of. There's no way that answer is going to be accurate. Even with our really detailed engineers I told you about that come in with 35 years of spreadsheets, there's usually something that we find. Sometimes people come in at $10,000 a month and their true number is 15 or 16. So you've got to get to the right answers in these financial plans. They have to be truly comprehensive, and they should be reviewed annually. The other thing that I hear from people, I wish I would have considered this earlier, is the use of life insurance for financial planning, future retirement income, and estate planning. Because the cost of life insurance is typically much better at age 55 than it is at 56, 57, 58, 59, 60. You get my point. As your age increases, doesn't mean it knocks it out of the park. We've placed good life insurance policies with people in their 70s. But it's easier at 55, I'll tell you. So that is a common one over and over again. Review to see if life insurance should be part of your plan. If it should be part of your plan, now funding it might be a completely different thing. But if it can be part of your plan and if it should be part of your plan, look at doing it as early as possible. So that's just another item, one of these critical items that I hear many people say, well, geez, I wish I would have done this prior. That's our list for today. That is our what you should be doing now. So let's just run through it again. Pay attention to details, expenses, investments, contributions, your tax category. If I can pound the table as hard as possible. I'm not going to do that here because it's going to mess up the video. But if I could pound the table the most about this, it's if you do nothing else other than pay attention to your tax category over the next year, if that's your one takeaway, you're going to be way ahead of the game. But while you're doing it, pay attention to your expenses, your investments, your contributions, all the other ones. Put together your team. Put together this team, your CFP, your CPA, your attorney, all working for you. Develop a true financial plan. Take the time, take the expense to truly develop a financial plan. You know, if you were having something built on your house, you wouldn't just slap together something. I hope you wouldn't. You'd have an architect come out and have your blueprints drawn. You'd have to have your permits and things like that make sure that they get done. I wish we had retirement permits. So now I sound like a big government person. I'm not. But if you had a retirement permit, you'd have to get all these things done. But geez, if you're gonna build a house, or if you're gonna do anything to your house, you're gonna have some structural assessments done. Get your structural assessment done. Get your blueprint done. Get your architect work done. That's your financial plan. Because now at 55, if you're going to retire at 65 or even at 60, if you identify potential issues, whether it's expenses or investments or your taxes or your insurance coverages, you're talking about long-term care insurance, life insurance, all these different things, you have a lot of time to write it, to correct it. If you start doing this when you're at or very, very close to retirement, it can be done, of course, but it's more challenging. And then if life insurance is to be part of your plan, and it is part of many, many financial plans, as folks, get older in their plans or when they develop true financial plans, and unfortunately that's typically later in life, then now is the time to be considering it. So I hope that's helpful. That's what you should be doing now at age 55. I hope you took away some good pieces from that. I look forward to seeing you all next week. We've got a couple questions. Roseanne asked, what is a CRPC? I don't remember the exact definition of a CRPC. Certified retirement. It has something to do with income. Certified retirement plan. No, I don't remember. I'm not gonna guess. There are many designations out there, and I'm not gonna. CRPC, I'm sure, is a fine designation. It is not the CFP. These designations are put out are from different schools. The American College is one, puts out a lot of different designations. They do a lot of, they also train people for the CFP, the American College. Well-respected organization, but let's face it, they make their money from putting together programs and putting out educations. And you could, when I did my Accredited Investment Fiduciary training, my instructor, he listed his name on the board with a whole paragraph of designations. So there are some that you could get on a weekend. Now I don't know if that's CRPC, but Roseanne, send me that in an email and I'll look it up. I just can't remember what that is off the top of my head. Jerry said, may I request a future seminar subject on funding options using life insurance regarding index universal life overfunding, etc. Yes, Jerry, you can. I'd be happy to talk about that. And Walter says, subscribe. So either Walter is reminding me to say, please be sure to hit the subscribe, and notification buttons. And if you are, Walter, I appreciate that. Or he's telling me that he just did like and subscribe. So listen, everybody, I hope you got something from this. I look forward to seeing you next week on this YouTube channel, whether it's recording, whether it's live. You should be having last week's recording delivered in your mailbox in about 28 minutes. If you want to receive emails from us and you're not already on our email list, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com, and we'll get you on that mailing list. If you just have questions, you can reach out to us at questions@attleborowealth.com. That's it for today. Hope you have a great week. See you next time.